From New York City, for our viewers worldwide, I'm Manus Cranny, in for Jonathan Ferro. This is the State of Play on markets. It's day two of the worst opening across assets since 1999. The countdown to the open, it begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up for you today, risk assets extend the new year hangover. Big tech edges lower. That's the consensus after the worst day since October. And traders look ahead to the Fed with payrolls on the deck. We begin with the big issue. What a difference a year makes.
It feels like we're coming into the new year, and now, of course, and we're already seeing a very the start of a reset, perhaps.
Starting off 2024 with a little bit of a breather.
We're just pausing for breath.
Investors start to take really a sober second look at what the economic environment is going to look like in the year ahead.
We had a very strong rally in the third quarter of last year.
Equity markets have rallied 16% from the low point in October.
Given the rally we've had,
it's an understandable, rational question to be posing at the beginning of the year. Was it overdone?
It's just a really great time to play a little bit of defense.
I don't think that you can have the kind of growth that we've had given the kind of economic backdrop that we're looking at.
The Fed is probably going to be disappointing here relative to the speed at which rate cuts are priced into the market.
We've got some key US data coming up this week.
We will look for confirmation of the inflation and economic data in the next few weeks.
Well, it was fast, it was furious, it was ferocious. Joining me now to break it down and discuss the markets, PIMCO's Aaron Brown, Peter Cheer from Academy Securities. Great to have you both with us. Day two of a reflective moment for markets. I want to put this to you. Bank of America's Savita Subramaniam writes this: a right in big tech, a broadening out of the market leadership is becoming consensus. But that means January's pain trade equals higher TMT and mega caps. Do you think it is quite a contrarian position to say that big tech is going to have a brutal day or month of realization? Peter, let's take it to you first of all. Good morning.
Good morning. I always like to be a contrarian, but I find this time of year, we just went through a December where people got forced into the market. The people went into the market kicking and screaming. We already saw a bit of a rotation out of big tech into Russell 2000 small caps from November 7th on. I think that continues, but I think it's now going to continue in a down market rather than an uptrending market.
Okay, I suppose it depends what happens to the 493 other stocks. Aaron, let's bring it back to you. We have a renewed gravitational pull. It's sucking us back towards 4%. So for this morning, and perhaps for this month until we see where the Fed comes down, we'll get some minutes later on in the day, is the gravitational pull just a better re-entry proposition for you?
I think that's right. I mean, if you think about the last really quarter of economic data, we had very benign economic data coupled with a more dovish Fed. And that, I think, really did pull a lot of people into the market, but also back into bonds. I think right now the fundamentals or prices have sort of outstripped the fundamentals. I do think that we'll get there over time, but I think typically January is a month where you see trend reversals. It's also a month, just given the extent of the rally, that you would expect to see a pause after what was a tremendous, sort of monster rally across all global assets. And so I think right now we're really just taking a step back, digesting the data, and we need to see the fundamentals now catch up with the market momentum and prices that we experienced in the fourth quarter of last year.
And that's where the divorce is. I want to get a sense from you. I mean, obviously you can evangelize, Aaron, in that bonds will emerge as the standout asset class. So I'll give that to you, but I want to know why, and in a relative sense, Peter, why should I think that bonds are going to be, it's going to be a great year for bonds relative to equities? Aaron, first of all, stand up the argument on bonds will emerge as the standout asset class, and if so, where on the curve will it stand out?
So firstly, we saw a really significant rally that I think brought forward a lot of the returns that we had expected in 2024 into the latter part of 2023. I wouldn't expect a replay of 2023, at least in the last quarter of last year, to percolate throughout the rest of 2024. That said, I still think that at sort of close to 4%, bonds still offer value to long-term fixed income and really global asset owners, given the fact that now we're starting to see them provide more defensive strategy, particularly in downward data or weaker data than expected. You're starting to finally see some of the diversification benefits of fixed income start to pick back up. Secondly, at about 4% return, that is attractive for a long-term owner with very low risk. And so if you think about that relative to the equity risk that you're taking in a portfolio, you're guaranteed, a pretty good return over the next sort of 5 to 10 years in a fixed income asset. I think that on top of that, you're also getting the benefit of capital appreciation. And I do think that as we see the data slow from here in the first quarter, you're not only going to get real yield return, but you'll also get capital return. So it's really this sort of trifecta of fixed income that you're getting now, which you haven't gotten, for much of the last several years across fixed income assets.
And a lot of people have put in their notes that we're going to be clip-on couping for the rest of this year and just pick up with an uplift. Peter, let me take it back to you. There's 4% over 10 years. Earnings have got to be pretty stellar to outperform that return. Although you are worried about the consensus. You say that you're torn over the weekend and we've got reckless bullish calls. By nature, I'm not reckless. I'm the middle of the pack. So just how reckless have the calls been on equities? And are you a bit cautious on that?
Yeah, I'm a little bit cautious on everything. One is I think the rates market has got ahead of itself. I think too many rate hikes are priced or rate cuts are priced in already. So that's going to put some pressure on the front end. At the back end, it was only a month and a half, 2 months ago, everyone was talking about the deficits in DC, how much interest was going to be part of the budget. No one seems to care about that now. I think that will creep back into the dialogue. So I think yields pushed a little bit higher, and that's going to weigh on stocks, right? We live in a world where there's pressure on yields. Equities really, really did phenomenally well. I think people are going to rethink that, especially when you start looking at the market cap of some of these companies. Are these market capitalizations justified? And I think the other story that's going to turn out to be completely, just non-existent is this whole, all this money has to come from money markets into the equity market. I don't think that's going to happen. I think people are very comfortable in their money market funds. I think a lot of money that had been traditionally held in bank accounts is now in money market accounts, and that's replacing the bank account. So I don't think we have this huge wall of cash on the sidelines waiting to come into the market at all.
Oh, that is heresy. That's heresy compared to what everybody's been telling us. That was supposed to be what will push us through. Listen, let's pause those thoughts for just a moment. Stay with me on the side. We're going to turn our attention to commodities because we've got oil fluctuating this morning. We've got fading optimism about the interest rate cuts. That's challenging cross assets all the way around. But also we have this rising concern about conflict in the Red Sea. Will Kennedy joins us for more. Will, you've just returned from 2-3 weeks in the Middle East. Here we are with quite a surprising ratcheting up of tensions. Iran sends a 40-year-old frigate to the Red Sea, and yet the market seems to assume nothing really to see here, but the risk is there is an accident waiting to happen geopolitically. Good morning.
Hi, Manus. Happy New Year to you. I think that's right. I mean, you look at events around the region today, and there are clear points of tension in the Red Sea and beyond. You have events in Lebanon where the Hamas commander official was taken out. You have terrorism in Iran itself, and yet oil doesn't get much of a bid from it. I think there are a few reasons for that. One, the market has been living with these risks for several months now and is coping with them. Two, there is a big degree of spare capacity within OPEC coming from the UAE and Saudi Arabia, which dampens the geopolitical premium because when push comes to shove, those countries could put more oil back into the market. But I don't think people should be complacent or dismissive about it. Clearly, there is a huge degree of tension in the world's #1 oil-producing region, and there are any number of ways that could have an impact as we go through 2024.
I was with Bob McNally this morning. You know I'm Rita very well. I'm Rita Sen and Bob McNally. Both of them, they're well known to both of us. Bob says we're in a funk, and it'll come down to, I suppose, seeing the deficits come into play that have been promised by the OPEC Plus grouping. Do you think that's the thing that can turn this market, Will, briefly?
Yeah, I mean, it's a supply and demand, as always, Manus. I think OPEC will cut. The question about is obviously they plan to cut. How much those barrels translate. I think people do want to see this surplus end. The big question is shale. The thing that really surprised the market last year was just how fast shale grew, much more than almost anyone predicted, 800,000 barrels a day. People are more modest this year, 400,000 barrels. They expect a slowdown. But if it's even faster or it continues to find ways to expand even quicker, that's one factor that can really upset the market in either direction.
Okay, Will, thank you very much. Good context there for the oil and energy market. Aaron Brown, Peter Cheer are my guests this morning. Peter, I come to you. Energy, commodity, it lacks that war premium bid, but you like energy for good and bad reasons. Give me the bid and the offer.
Yeah, so one reason, we're very fortunate at Academy Securities. We have 18 retired generals and admirals who serve as our geopolitical intelligence group. So I feel we're pretty plugged into what's going on. I think the risk of escalation in the Middle East is high. We've been allowing, as a country, Iran to sell far more oil than they should be under sanctions. So that risk of escalation means Iranian oil could come off the market. Except from that, I think I actually like energy stocks much better than energy itself. So I think we're going to see growth. And so we just kind of went through the bad reasons, which is geopolitical. I think the good reasons are there's a shift in the ESG mentality and how people are thinking about sustainability. And I'm seeing a real progress towards a 10 and 20-year plan where there's a realization we are not going to be sustainable only in a year, 2 years, 3 years, whatever kind of people dreamt of. We are going to have ICE vehicles for a long time. We're going to need energy. And I think that's going to fuel a lot of growth, no pun intended, for the energy companies. And I stick to this mantra, which I've been using for 3 or 4 years, is that the energy companies of the future are actually the big energy companies of today. So I really like them better than the commodities themselves.
Yeah, big energy just reincarnated. Let's put it back across to Aaron. Look, to a certain extent, the standout asset of choice for you is going to be bonds. Part of that is going to be the disinflation narrative. And second to that, I want to get a sense from you, to what extent does a geopolitical risk play into the bid for bonds as a backstop or as a portion of hedge, let's say?
So I think that's right. I mean, I think over the last 2 years, you haven't really received much of a hedge from global fixed income assets, just given the inflation picture was quite, detrimental to fixed income as an asset class and certainly as a hedge. That now has turned. You now see the tables shifted. Inflation projections are likely to continue to show that inflation is going to move lower throughout the course of this year. And you can start to see fixed income really perform like it has in the past as a diversifier and as a hedge for the global assets that you hold in your portfolio. And so I think now for the first time, in at least 2 years, that we can credibly say that fixed income is back as a defensive asset and as a hedge to your portfolio. And that's one of the reasons that we, do think that there's real value to fixed income now in portfolio construction.
Well, now, to be fair, it took a bit of time for the old bond market to waken up to being the hedge of hedges last year, and it didn't exactly perform very well for us in the front 8 months. But let's see, we've got a long road to run, and of course we have an election at the back end of the year. We didn't get there. I'm sure you will get to that with Jonathan in due course over the next couple of weeks. Aaron Brown, Peter Cheer, thank you for being there, and they are going to stick around. We've got more work to do on the Fed. Joining us now to look at the movers ahead of this opening bell, Abigail Doolittle is side by side with me. Abby.
Well, Manus, there is overall a bearish tone. We're looking at the S&P 500 and the NASDAQ heading to a potential 4th down day in a row for the worst loss since the end of October. Over that time period, not surprisingly, weighing some of last year's big winners. In fact, NVIDIA, the biggest winner of last year, up more than 240%. The chip maker now heading to a 2nd down day in a row. Consolidation, investors getting a little more defensive. The SOX, in fact, that chip index technically looks very vulnerable, so it may turn into a little bit more of a pullback, but we'll see. Coinbase reversing the big gain recently, down today, this morning in the pre-market, down 7.5%. This is, there's some speculation that the SEC may not be as fast to approve Bitcoin ETFs as had been previously thought. Plus, with the risk-off tone, investors heading out of Bitcoin. And then finally, Disney down just slightly. And of course, this board battle intensifies as both ValueAct and Blackwells make moves that align them with CEO Bob Iger versus Trion's Nelson Peltz trying to make a move onto that board. More on that on the Open, Manus.
Okay, let's see how they react and how Apple behaves at the Open as well. Coming up, the IMF is expecting the Fed to secure a soft landing.
People should be feeling good about the economy. The inflation moderating already and continuing to moderate is due to the decisiveness of the Fed to increase interest rates.
Traders gearing up for the Fed minutes, along with a host of economic data this week. That conversation up next. This is Bloomberg.
People should be feeling good about the economy because they finally would see relief in terms of prices. The inflation moderating already and continuing to moderate is due to the decisiveness of the Fed to increase interest rates. And while that has been painful, especially for small businesses, it has brought the desired impact without pushing the economy into recession.
The IMF's Georgieva there saying the Fed has achieved a soft landing. The FOMC's December minutes are right later today. Jay Powell admitting that the meeting officials had discussed rate cuts. Since then, some officials have pushed back on that dovish pivot, but there's more data on the deck this week, including the jobless claims ahead of the December payrolls. We got jolts today. Also set to show that Powell is right about whether inflation can slow without impacting the labour market. Mike McKee is with us now. Will something change between December the 1st and December the 13th? Mike McKee, tell us, what's the data going to show us today and tomorrow and Friday?
Well, everybody's looking forward, Manus, to seeing what the minutes say and whether there's any kind of real pushback in there to the idea that the markets took away from the meeting in December, that the Fed's going to be cutting rates a lot. Tom Barkin, the Richmond Fed president, with some warnings that you need to take this in context, that there are 19 different people who make their forecasts, and that it's only in that context in which the forecasts are right and inflation does, in fact, continue to settle, that they forecast rate normalization to begin sometime this year. He points out that the rate forecast range of estimates was pretty wide. And he says, I would caution you to focus less on the rate path and more on the flight path. Is inflation continuing its descent, and is the broader economy continuing to fly smoothly? Well, as you mentioned, Manus, we get some data that will give us some ideas about what the context of all this is. We get the jobs report on Friday. 170,000 is the forecast. 3.8% unemployment, not really going to tell you that things have slowed down a lot. Then we get, of course, CPI next week. That's going to get a lot of focus in the markets. We should see some base effects there that maybe even push it up a little. December retail sales, and then fourth quarter GDP, which looks to come in about 2%, not a slowdown of any significance. And then December PCE, the Fed's numbers, and then we have that meeting at the end of December, and we'll see what they tell us then about what happens next. Today we also get, as you mentioned, the JOLTS report and ISM. And ISM is supposed to go down a little bit, but these are the numbers that Wall Street's really going to watch, the sub-indexes that tell us something about the prices paid, employment, and new orders, to see which way the factories are leaning. And they've been going up, and they're expected to sort of level off. But watch that prices paid. It went up to 49.9 last time. The forecast is for it to come down to 49.5. But if it doesn't, that could be a wrench in this story that the Fed is going to be cutting a lot.
Well, it could help reawaken the odd bond vigilante. There's a risk for you. Mike, thank you very much. Mike McKee, setting the agenda for the data over the next 3 days. And today, critically important on that agenda. The talk of last month's Fed meeting was Chair Powell's pivot. He started the month saying this: it would be premature to conclude that the confidence we have achieved a sufficiently restrictive stance or to speculate on when policy might ease, then pivot. 13th December, Powell mentions cuts post the decision, saying, quote, that begins to come into view and clearly a topic of discussion out in the world, and also a discussion for us at our meeting today. So are they going to achieve a 1995 soft landing? The lady with the answer to that is Erin Bryan. Is that your core belief, Erin?
So I think that whether they achieve a soft landing or a slowdown into a softer landing is probably the question to ask. And we're not expecting by any means a hard recession. We do think that there's going to be softness throughout this year with declining inflation. So if that's what you define as a soft landing, I don't think we're going to be off to the races with respect to growth. And this is a new sort of inflection point for more positive growth. I do think it's going to be a more challenged year for growth this year, but we'll likely avoid, sort of the left tail of a hard recession. In that environment, asset classes can do well, but I would say that they'll do well in not a linear straight line, but also in a more measured or more moderate pace than what we experienced certainly from last year. So I think that this is an environment where all eyes today are going to be on the Fed, where they're really going to be looking for insights and clarification with respect to, what those minutes are suggesting, not just for the pace of rate hikes, but when it's likely to start. The market's already underwritten a pretty aggressive rate cutting cycle. And so that's, I think, going to be the key point to look at later today.
Peter, in terms of extending risk and taking risk, what do you need to hear in 30 seconds?
I really need to see the economy chug along. I think we need to see decent job numbers. We need to see consumer spending continue. I think that's where the risk is. If the consumer slows down into this geopolitical tension and the Fed kind of pushes back a little bit, I think that's where we get this risk off trade. We get yields go a little bit higher, and we could see the S&P pull back below 4,500. So that's what I'm thinking, and I need something to change my view, and I'm not seeing that yet this year.
Okay, 47.63 is where we are on the futures. Unconvinced. Peter Cheer, Erin Bryan. Let's see what the Fed minutes have to say and the data. Coming up over the next 37 minutes. The morning cools. We got Hightower's Patrick Frizzettia. He joins me with his outlook for the year ahead. All that conversation to come right here on Bloomberg. Time for your morning calls. Let's see what the analysts are describing this morning. First up, KeyBank upgrading Verizon to overweight, expecting the shares to benefit from favorable setup and easing competition. Mizuho downgrades Exxon to neutral, seeing limited upside on commodity prices. Where's the commodity supercycle gone? Finally, Wealth Research upgrades Citigroup to outperform. They're not the only ones, pointing to numerous tailwinds and the stock's compelling valuation. Coming up, we'll talk about those stocks and the mood in the markets with Hightower's Patrick Frizzettia. He joins me very shortly, bull or bear, on day 2 of this global market reflection on Bloomberg. This is Countdown to the Open. I'm Manus Cranny, in for Jonathan Farrow this morning. We're just waiting for the cash trading to start. You had the worst start to the year for across the assets since 1999. Nasdaq was down 1.7% yesterday. You're looking at a pretty brutal moment of reflection. By the way, the flow of money into these equity markets, $19 billion went into these markets through to the close of business on the 27th. For the flow is there. The question is, there is a lack of conviction in this morning's first trades. It's day 2 of a pretty tortured opening, the worst since 1999. In terms of the rest of the assets, you can see here the debate is whether it's going to be risk or rates that define the trajectory for the dollar. We had Rabobank with me this morning saying that Jane Foley has some sympathy for parity in terms of the euro because that Europe is so challenged at the moment, and the ECB will probably be outcutting the Federal Reserve. 10-year yields pop a little bit higher. The gravitational force, as Katie Greifield crescented last week, is heading towards 4%. What would that do to the technology trade, and crude is still mispricing war premium to the extent of around $12, according to Rapid Energy, even though it bounces by nearly 2% on those rising escalation and threats between Israel and Lebanon. We're waiting for some confirmations there. There are opening trades and timestamps to be had. Apple is on the block, the tech giant extending its decline for a third session after leading the way lower on Tuesday. Ed Ludlow joins me with more. What happened to the $4 trillion valuation that we were told about last week? Ed Ludlow, why, oh why, the shaking shivers in Apple? Good morning.
Good morning. Well, there's a narrative that's building of the Magnificent Seven we talked about so much in 2023. Apple perhaps is the least magnificent of the lot. We're down another 0.5 percentage point, as you said, a third straight day of declines. It follows Tuesday's session where Apple had a decline of 3.6%, its biggest drop since the end of September. The catalyst being that downgrade from Barclays, a change in price target to $160 a share, just a $1 trim, but moving Apple to underweight. Their thesis is basically that the stock defied gravity in 2023, right? You had several quarters where earnings missed expectations, and yet the stock grows 50% on the year to a record, a $3 trillion market cap. They don't see that lasting. Their analysis is based at looking at the volume and mix of iPhone 15, the latest generation iPhone, having concerns, and then looking ahead to the iPhone 16 and saying, we don't feel there's enough on the technology cycle, technology upgrade perspective to keep driving this stock forward. We care as well because it had an impact on markets, right? This was the biggest drop for Apple since the end of September, but it also pushed the NASDAQ 100 to its biggest one-day drop since the end of October. Biggest points decliner on both the S&P 500 and the NASDAQ 100. So that will be the story for 2024, right? How magnificent will Apple be? Will it defy gravity as it did in 2023? And what will be the catalyst to drive growth? If not iPhone, some other category, be it services or another device.
You know what they say, Ed? Smile on the way up, but I don't think anybody's calling time on Apple just yet. Ed Ludlow there on the Apple moves. We're also keeping an eye on Disney. You got Blackwell's Capital will nominate 3 directors at the entertainment giant to preserve Bob Iger's vision. Abigail Doolittle has the latest on that. Preserve or shake up? That's what goes through my mind. Abby, good day.
Well, good day and good morning. And I think that this overall is a board battle that is intensifying because we, of course, have had Trian's Nelson Peltz in the mix for quite some time. But today we do have 2 firms, ValueAct and Blackwell's, essentially saying that they are going to enter the fray on the side of Disney and Bob Iger well ahead of the company's annual meeting that typically occurs in March or April. Now, to set the stage again, Nelson Peltz's hedge fund, Trian Partners, they plan to nominate 2 candidates to Disney's board this year. They have a roughly $3 billion stake, intensifying their roughly year-long campaign against Disney for change, saying that the board is too cozy to CEO Bob Iger and that they are disconnected with shareholder interest. Now, this morning, ValueAct saying it will support the Disney board's recommendation. They also have a confidentiality agreement where it sounds as though there could be some information being exchanged there, some advice being provided. Then Blackwell's, as you mentioned, entering the fray, nominating 3 people to the board and vowing to preserve Disney's Iger's vision. Not only that, they're also demanding that Peltz immediately end his campaign for change. What makes all of this interesting, Manus, of course, is the fact that the stock down more than 20% from last year's peak. This is a situation that could continue to develop ahead of that annual meeting this spring, where shareholders will, in fact, get to vote. And it's going to be interesting to see who they will be voting on at that time.
Yeah, well, they want a higher stock price, and that involves change. Abby, thank you very much. Abigail Doolittle. Sticking with the boardroom, we've got Bloomberg Brands. They're naming 2 directors. It's new cooperation agreement with Starboard Value. What are the details? Simone Foxman is with me. Simone, what have we got?
Yeah, Manus, I don't know if you've been to these restaurants yet. Outback Steakhouse, Bonefish Grill, that is Bloomberg Brands. These 2 new board members are part of an agreement with Starboard Value. One is from Starboard Value, John Sagal. The other, Dave George, had been the COO of Darden Restaurants. Starboard now owns about 9.7% of the company's common stock. That was originally disclosed back in August. The company also said that it's going to form an operating committee. Those 2 new board members as well as 2 current board of directors members to look for ways that it can improve the brand. Starboard Value, really known for its successful proxy fight with Darden Brands. That got a bit combative a couple years ago back in 2024, and it eventually resulted in Starboard taking full control of the board. So far, we're not seeing that same sort of relationship between Starboard Value and the brand here. In fact, Jeff Smith, the CEO of Starboard Value, saying that Bloom & Brands had been collaborative and open dialogue so far. But this news causing Raymond James to raise its price target to $30 a share. The company's shares are already up 39% since last year. They were up 39% last year, I should say. They were up roughly 10% since Starboard Value announced was reported to have taken its stake back in August, but they're still about 10% below hitting their April 2021 high, and we're seeing a little bit of a pop this morning, Manus.
Yeah, the thought that goes through the mind is where they're going to trim the fat on the steak on that, excuse the pun. I like the look of Fleming's. Looks very, very regal, very reminiscent of a British eatery. And Bonefish Grill, I'm all in on that. Simone, thank you very much. Simone Foxman with the very latest in the boardroom battle. Let's turn our attention to crypto. Coinbase leads the sector lower. Speculation, I get this. Spot Bitcoin approval. There you go. Katie Greifield. I mean, this has got a bit of a shakedown. ETFs, we were talking about them last week. What happened? What's gone wrong? Why?
Well, right now you're watching Coinbase, Marathon, Riot, all taking a bath right now alongside a plunge in Bitcoin. That plunge as much as 9% this morning, briefly breaking below $41,000 per coin. And as you mentioned, Manus, speculation around a potential spot U.S. Bitcoin ETF finally launching. It's at a fever pitch right now. So to set the stage here, the SEC has a deadline coming up next week to take action on one of the dozen or so applications in their queue right now. And the current thinking is that they'll either approve or reject all the applicants at once rather than playing kingmaker here. So as you would expect, rumor, innuendo, it's at an all-time high right now. That's translating into volatility, both in Bitcoin itself and those crypto-related stocks. But it's important to note that all of these assets, all of these names, they're coming off a banner 2023. Take a look at Coinbase. It surged nearly 400% last year alone. So what you're seeing could be as simple as people selling the rumors, selling the news, choosing to take profits here rather than waiting around.
Okay, Katie, let's keep an eye on that. The ever-giving story of the ETF. Patrick Frizzetti is with Rose Advisors. He's weighing in on the new year. This is what he says. The market appears overly optimistic, as I do not think we are out of the woods on inflation. The genie is not going back in the bottle without a cost. Patrick joins me now. I'm focused on the cost, which implies higher for longer or the Fed is not done. Good morning. Be the contrarian for once.
Yeah, I'll be a contrarian. I think 2023 was a year well explained by, first it started out with a banking crisis. The Magnificent Seven outperformed until rates peaked, right? Rates peaked in late October. Then you started to see the equal-weighted S&P stocks outperform those tech stocks. And I think, when you think about as, lower rates and the Fed lowering rates started to price into the market, there's two expectations. Two things really, justify lower bond yields. And that is inflation's going back to 2%, or something else worse is happening, like we're going into recession. And I think it's very unlikely that inflation gets back to 2% anytime soon.
Well, that's going to take some kind of a spike in unemployment to really contain the last mile, the last leg, the last 1%. You say that this is an opportunity for equities to rebalance. This is an opportunity for me to rebalance. So where do I rebalance out and into?
Yeah. Look, I look back to the prior year, 2022. You look at what helped, what was defensive in 2022 when the market was down a lot, and then what underperformed in 23. Look at things like energy. Look at materials. Even the healthcare sector overall. I mean, think about pharmaceuticals in an election year. Pharmaceuticals won't be on the hit list in an election year, which it typically is. And I think I look to those sectors to potentially outperform this year.
You're not convinced, by the way, that the money market funds flow as munificently as other people think. I've already had people kick back against that this morning. Why do you think the money sticks in money market funds for longer than we presume? That's what I'm thinking, which is why would I give up 5.3% to take equity risk if there's already a shakedown at the moment?
Yeah, you won't. You won't. I mean, if you were giving up all those gains and you weren't chasing the momentum of 2023 and you were sticking with 5.5%, 5.25% money market funds, you're not going to go into these high priced or high multiple stocks right now. It's not going to become a risk on trade. I think they'll stay where they are, or maybe they move some of the money into bonds or extend some duration or something along those lines. But I can't see adding on significant risk if they've been sitting out much of the momentum in 23.
Okay, well, maybe it just takes a chunky cut from the Fed in the first instance rather than that sort of slow drift of 25 bips at a time to shift the money out of money market funds. Patrick, stay with me. Patrick Frusetti, my guest on the markets. Coming up, Mike Mayo doubles down on the bullish call for Citigroup.
I understand Citigroup's mistakes, but what's different this time is the result of this restructuring should be a much more simple Citigroup, not a more complex Citigroup, and that's night and day.
The recent rally in banks sending JP Morgan to fresh record highs. Where are they winning? We'll break down the financials. That's next, right here on Bloomberg.
My top three picks for 2024 are Citigroup, Citigroup, and Citigroup. I think the bottom line is that Citigroup is becoming a much more simple and profitable firm whose earnings should double over the next 3 years. But this is make or break time for Jane Fraser. You said, is this due to Jane Fraser? Maybe. I think so. Yeah. But not definitely. I understand Citigroup's mistakes, but what's different this time is the result of this restructuring should be a much more simple Citigroup, not a more complex Citigroup, and that's night and day.
Wells Fargo, Mike Mayo, doubling down on his bullish call on Citigroup, but not necessarily on Jane Fraser. Now, the bank superseded JP Morgan as his top-rated big bank stock for 2024. The analysts expecting shares to more than double over the next 3 years. Alison Williams joins me now from Princeton. Alison, good to have you with us. It's an interesting nuance, isn't it? I'm bidding up Citi, I'm putting them up on the stack, but I'm not convinced it's all to do with Jane Fraser. But this entire restructuring, I'm understanding, is Jane Fraser.
I think Jane Fraser is the difference this time. I think for an investor to buy Citigroup, they have to believe that this is the time the restructuring works. And let's be clear, the valuation of Citigroup, it's traded at a discount to book for a long period of time. And I think that reflects doubt. This is a stock that, for decades, many investors, many sell-side analysts have said, look, there's a lot of opportunity here. This is a company with a lot of great businesses. If they can just, improve their efficiency, get their act together, shed some unprofitable businesses, it should be a great stock. Unfortunately, many of those calls have been disappointed. And so it's been many, many years of trying to reach a target and not being able to reach that target. So the medium target for Citigroup now is 11 to 12%. The cost ratio to get there is something that they're still way far away from. And so the question is, can they get it done? Jane Fraser has made some tough decisions, exiting businesses that the bank has been committed to forever. Yeah. And I think two things. One is Jane Fraser, but two is, I think one of the best things that's happened to Citigroup is the regulatory scrutiny that has forced a lot of the transformation and has forced them to improve their risk systems, forced them to do a lot of the spending that perhaps they should have done decades ago to bring together all the disparate businesses that were purchased and brought together under one umbrella, and not necessarily integrated in an efficient way.
Well, that takes us back to November when Jane Fraser shuttered a business. They were so committed to the muni business. It was like inextricably linked. Alison, thank you very much on the banks. Let's turn our attention to JP Morgan, soaring to record highs for the first time in over 2 years. Though CEO Jamie Dimon has warned the bank is over-earning in some areas. What does he mean by that? Abby?
Well, their tremendous profit last year, they just did a tremendous performance. And what's so interesting here, Manus, is that, of course, JP Morgan is considered to be the best in class, in large part because of CEO Jamie Dimon. Now, the stock may be down just a little bit today, but yesterday, to your point, they did put in a record high, the first one in more than 4 years. And if we take a look at JP Morgan last year, that over-earning that you were just talking about, referenced by CEO Jamie Dimon, the stock up 27%, the best year since 2019. This as the KBW Bank Index, or the benchmark, down 5%. So some clear outperformance. Investors flocking to Jamie Dimon's best-in-class, largest bank in the wake of the collapse of those regional banks in early 2023. Plus, they benefited from the acquisition of failed bank First Republic from FDIC. In fact, we had a clip earlier of Mike Mayo, Wells Fargo analyst. I'm not sure if this was from yesterday, but he did say of JP Morgan, Goliath is really, really winning.
There you go. You haven't got a JP or an minute. You're not in it. Abigail Doolittle there. Let's turn back to my guest, Patrick Frusetti. Patrick, would you be long banks? Is there anything that could convince you to be long a bank in the United States of America?
Not at the moment, to be quite honest with you.
Why?
Because look, we're what, 10 months out of a banking crisis, and we still haven't seen, I think, the worst of the commercial loan issues and defaults. We don't know where the bodies are buried, so to speak. And you have these large bank balance sheets there. You were talking about Citigroup, and this is what the big banks do. They restructure, every once in a while, then they try to get back on track. And I think the commercial loan issues that banks are going to have to face, could create a lot of problems. There was a new Fed paper out that basically did some sensitivity analysis and talked about, just a 10% move down, what that would mean to Tier 1 capital. And if you see a 20% move down, you'll see a big impact to Tier 1 capital of the large banks. And that's the thing why I think there's just better things to buy out there, and I've avoided the banking sector. It's not to say I've always hated banks. It's just to say at the current moment, given what could potentially be, I think, a crisis, and many have thought it. They've just been waiting it out. Well, when is the cliff going to come? When is the cliff going to come? And I think it's eventually, until I have some more information on that, on that data, it's very hard for me to invest in banks.
No, listen, I know once bitten, twice shy on some of these banks, and certainly last March, nobody saw that truck coming to roll over the top of us. In terms of 2024, do you want to be? I know that you want to be longer, slightly more defensive plays, but is that something slightly more, dare I say it, boring? I mean, if I said to you Novo Nordisk was going to be a boring stock in Europe, you'd probably laugh at me. But here we are. Pharma is very much a big play, isn't it, in terms of the weight loss drugs and in terms of cancer treatments? Where do you want to be, if not in financial?
Yeah, I mean, I like healthcare. I like the pharmaceutical space. I really like materials. I mean, if we're going to have a weaker dollar, I mean, if rates are going to go down, if the Fed is going to cut, which I'm not a believer that they're going to, the market may be pricing in too many cuts, I think, at the moment. But if the dollar's weaker, you want to own materials, you want to own energy. And like I said earlier, this might be the first election year where pharmaceuticals are not, at the top of the hit list for, one of the political parties.
You mentioned election very briefly, literally in 30 seconds. Do you think this market will back up and front run that election in 30 seconds? Do you think we'll see real action in September and then quiet?
It really depends how close the race is. If the race is close, you could see that, and then post-election, the market tends to rally because markets don't like uncertainty, and then when they get, they find out who the victor is, assuming we do, the market tends to rally into the end of the year. That's simply.
That's why we pay commission to people like you. You're supposed to be smarter than us and have the answers to that. Patrick, I'll leave you with that nervous twitch for the rest of 2024. Patrick Frizzetti. Coming up on the show, market moving events that you need to keep an eye out for your trading diary. We'll break them down for you from manufacturing to jobs right here on The Open. This is Bloomberg. Time now for your trading diary in terms of what we're watching. By the way, all that argument about a breadth in market, yeah, that's history. Down 1.5% on the Russell there. You're also seeing the rest of the markets take a little bit of a breather ahead of some of the data that we've got. The ISM manufacturing numbers and the JOLTS data, they will hit the tape at the top of the hour, so just under 4 minutes away. Following that, it really is the nuances of the minutes. Will they confirm and validate the Powell pivot? That is at 2 p.m. Eastern Time. Thursday, you got the jobless claims. That is the curtain raiser to the main event. You thought you had Christmas Day and Thanksgiving. No, it is the jobs report for December. Let's see what the payrolls number give us there. It is pretty important. Okay, stocks and bonds are having the worst start to the year since 1999. Where were you in 1999? Countdown to the open for this morning.